Welcome to our comprehensive guide on bonds and fixed income investments. In this video, we'll explore the fundamentals of bonds, their importance in the financial market, and how they can be a crucial part of your investment strategy. But first, what exactly are bonds? Simply put, bonds are loans made by investors to entities like corporations or governments. In exchange, these entities agree to pay back the loan amount with interest. This interest payment creates a steady income stream, which is why bonds are often referred to as fixed income investments. Bonds provide a predictable and stable return on your investment, making them a safer option compared to the volatile world of stocks. They also play a significant role in diversifying your investment portfolio, helping to balance risk and reward. Throughout this guide, we'll dig deeper into various types of bonds, explain how they work, discuss their risks and benefits, and explore different strategies for investing in them. Whether you're looking to diversify your portfolio, deepen your financial knowledge, or simply curious about financial markets, this video is for you. Let's embark on this educational journey together as we unravel the world of bonds and fixed income investments. Let's start with a fundamental question. What are bonds? Bonds are essentially loans made by investors to borrowers, which could be corporations, municipalities, or governments. These borrowers issue bonds to raise funds for various projects and operations. In return, they promise to pay back the principal amount on a specified date, along with periodic interest payments. Bonds come in various forms, including corporate bonds, municipal bonds, and government bonds, like U.S. Treasury bonds. Each type of bond has distinct characteristics and serves different purposes in the financial markets. Now, let's dive deeper into how bonds work and what makes them a critical component of a well-rounded investment portfolio. Bonds operate on the principle of the exchange of capital for the promise of future payment. As we move forward, you'll see how different types of bonds fit into this framework and explore their unique attributes. We'll guide you through the essentials to understand why bonds can be a valuable asset in your investment strategy. Fixed income investments are instrumental in providing a steady and reliable income stream through interest or dividends. Examples include bonds, treasury bills, and certificates of deposit. Essentially, fixed income refers to any type of investment that provides returns on a regular schedule. Bonds pay interest periodically, while treasury bills and certificates of deposit offer fixed returns over a specific period of time. By incorporating fixed income investments, you can achieve greater financial stability and reduce overall risk. They act as a cushion against market volatility, providing a predictable income that can be especially beneficial during economic downturns. Fixed income investments are crucial for anyone looking to stabilize their investment strategy and ensure a consistent flow of income. As we move forward, you'll see how these investments can serve as the backbone of a resilient and diversified portfolio. Stay tuned as we dive deeper into the world of bonds and the myriad ways they can fortify your financial future. Now let's explore the benefits of investing in bonds and fixed income. One primary advantage is the stability and predictability these investments offer. Unlike the often volatile stock market, bonds provide a more secure and consistent performance. Additionally, bonds and fixed income investments play a crucial role in diversification. By adding them to your portfolio, you can spread risk across various asset types, reducing overall exposure to market fluctuations. Another significant benefit is the generation of a steady income stream. Bonds regularly pay interest, which can offer reliable income, especially during market downturns. In summary, bonds and fixed income investments bring stability, diversification, and income generation to your investment strategy. As we move forward, you'll see the potential risks associated with bond investments and how to navigate them effectively. While bonds are generally considered safer than stocks, they are not entirely free from risk. Interest rate risk is one significant concern. As interest rates rise, bond prices typically fall, impacting their value. Another important factor is credit risk. This is the possibility that the bond issuer may fail to meet their obligations, leading to losses for investors. Finally, there's inflation risk. Over time, inflation can erode the purchasing power of the bond's interest payments and principal. Understanding these risks is crucial for investors seeking to make informed decisions about bond investments. As we move forward, you'll see practical ways to mitigate these risks and make smarter investment choices. Investing in bonds offers several methods to suit different financial goals and risk appetites. Let's explore these options in detail. First, you can opt for direct purchase, where you buy individual bonds through a broker. This method provides control over your investment choices, but requires a keen understanding of bond markets. Another popular route is through bond funds. These are pooled funds managed by professionals that diversify your investment across a variety of bonds. Bond funds can simplify the investment process, yet they come with management fees. Lastly, exchange-traded funds, or ETFs, provide the flexibility of trading like a stock while diversifying like a bond fund. ETFs often have lower fees than mutual funds and can be a versatile addition to your portfolio. Each method, whether it's direct purchase, bond funds, or ETFs, has its advantages and considerations, tailored to different investor needs. As we move forward, you'll see how strategic planning can enhance your bond investment returns and manage risks effectively. There are several strategies that can help you optimize your bond investments. One popular method is laddering, which involves staggering the maturity dates of your bonds across different periods. This spreads risk and provides regular opportunities to reinvest. Next, there's the barbell strategy. This approach combines short-term and long-term bonds, aiming to maximize return while minimizing risk. Short-term bonds provide liquidity, while long-term bonds offer higher yields. Lastly, the total return approach focuses on both income and capital gains. This strategy involves actively managing a bond portfolio to achieve the highest possible total return, balancing yield generation with price appreciation. As we explore these strategies further, you'll see how each one aims to balance risk and return, catering to different investment goals and market conditions. We'll delve into practical examples and scenarios to illustrate how you can implement these strategies effectively. Up next, we'll discuss how to analyze bond performance with key metrics such as yield, duration, and credit rating. To understand how a bond is likely to perform, investors need to pay close attention to three critical metrics: yield, duration, and credit rating. Yield is essentially the return an investor can expect from holding the bond. It's a key indicator of the income potential. Duration, on the other hand, measures the bond's sensitivity to interest rate changes. A longer duration means higher risk if interest rates rise. Credit rating assesses the creditworthiness of the bond issuer. Higher-rated bonds are generally safer, but offer lower yields, whereas lower-rated bonds come with higher returns, but increased risk. Assessing these factors helps investors to gauge both the potential returns and the risks associated with any given bond. It's about balancing the reward you expect with the level of risk you're prepared to accept. As we move forward, you'll see how applying this knowledge can transform your investment strategy. Next, we'll delve into real-world case studies, illustrating how these metrics play out in actual bond investments. Let's delve into some compelling real-world examples of successful bond investments and the invaluable lessons they offer. These case studies highlight practical applications of the principles we've covered throughout this guide on bonds and fixed income. From corporate bonds that have weathered economic storms to municipal bonds that have funded community advancements, each example showcases strategic decisions and their rewarding outcomes. By examining these success stories, we'll uncover the nuances that led to profitable investments, emphasizing the significance of thorough research and careful analysis. These cases not only reinforce the concepts we've discussed, but also provide a blueprint for making informed investment choices. As we review these stories, consider how the strategies and insights can be applied to your own investment journey. Each lesson learned serves as a testament to the power of bonds and fixed income as foundational elements of a diversified portfolio. Now, let's draw from these real-world successes and equip ourselves with the knowledge to make sound investment decisions. As we draw to a close, let's wrap up with the key takeaways. Bonds and fixed income investments are foundational elements of a well-rounded portfolio. Throughout this video, we've explored their core concepts, advantages, potential risks, and various strategies to maximize returns. While these investments offer stability, they come with their own set of risks, but with the right knowledge and approach, they can significantly enhance your financial strategy. Remember, always conduct thorough research and consider seeking advice from a financial professional. Thank you for taking this journey with us. We hope you've gained valuable insights into the world of bonds and fixed income investments. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more in-depth financial content. Stay informed, stay invested, and we'll see you in the next video.